Section 1, The Legend and the Myth. Warren Buffett, the name itself is legendary in the world of finance. It brings to mind incredible wealth, folksy wisdom, a seemingly magical ability to pick winning stocks. For decades, he's been the undisputed king of investing, the Oracle of Omaha. His every move scrutinized by Wall Street and Main Street alike. His company, Berkshire Hathaway, has delivered returns that have turned early investors into millionaires. And his annual shareholder letters are treated like sacred texts. When you think of investing, you probably think of him. He represents the pinnacle of long-term success, discipline, and patience. But with this legendary status comes a great deal of misunderstanding. A popular myth has formed around Buffett's strategy. Easy to understand, but ultimately incomplete. The common advice you hear is to simply buy and hold forever. Pick a great company, Coca-Cola, Apple, invest your money and then forget about it for the next 50 years. This paints a picture of a passive, almost hands-off investor who simply waits for the decades to roll by. It's a comforting idea, a one-time decision and a lot of waiting. This oversimplified version often discourages people from looking any deeper. This is where James Altucher's book, Trade Like Warren Buffett, comes in to challenge our assumptions. The book's title itself is provocative. Trading and Warren Buffett seem to exist in completely different universes. Trading implies active, frequent decisions, while Buffett's public image is one of extreme, almost geological patience. Altucher argues the buy and forget myth misses a crucial part of the story. He suggests Buffett is far more active, tactical, opportunistic. The book's core idea: learn from Buffett's true methods, not the myth, to make smarter, more timely decisions. The truth, as Altucher presents it, is that Buffett is not a passive statue. He is an intensely active evaluator of businesses and markets. He is constantly on the hunt for opportunities, assessing companies and making calculated decisions about when to buy, when to hold, and crucially, when to sell or reallocate capital. This book isn't about day trading or wild speculation. It's about adopting the mindset of a shrewd business owner who actively manages their assets, blending the timeless wisdom of value investing with the practical reality of navigating today's dynamic markets, a perspective far more empowering than simply buying and hoping for the best. Section 2, Trading versus Investing, a new perspective. So what does it really mean to trade like Buffett? The book quickly clarifies that this is not about chasing short-term price swings or gambling on market rumors. Instead, it's about redefining the act of trading through Buffett's intelligent lens. Altucher proposes a powerful synthesis: value investing and the tactical awareness of a trader. Value investing at its heart is about buying a wonderful business for a fair price, or better yet, a wonderful business for a price far below its actual worth. You are buying a piece of a real company, not just a flickering ticker symbol on a screen. This is the foundation of everything Buffett does. However, the book emphasizes that identifying a great value is only half the battle. The other half is execution. This involves the tactical decisions of when to enter a position, how much capital to allocate, and when to exit because the company is no longer undervalued or a better opportunity has emerged. This is where the trading aspect comes into play. It's not reckless speculation, it's disciplined action based on clear rules. This blend of long-term value perspective with short-term tactical decision-making creates a robust framework that is both patient and agile, allowing an investor to capitalize on market inefficiencies without falling into emotional traps. Throughout this video breakdown, we will walk through the core lessons of the book, chapter by chapter, to build a complete picture of this powerful strategy. We'll start by debunking the common myths and uncovering what Buffett's real strategy looks like in practice. From there, we will dive deep into the critical concepts of valuation and margin of safety, learning how to determine what a business is truly worth and how to buy it at a discount. You'll see why Buffett's legendary patience is not passive waiting but an active hunt for the perfect pitch, and you'll learn the specific signals that tell him when it's time to buy. Furthermore, we will explore the often neglected side of the equation, when to sell. We'll cover the logical rules for exiting a position because the company's fundamentals have changed or its price has become overinflated. We'll also examine risk control, using market volatility to our advantage and applying these timeless principles to our modern, fast-paced markets. By the end, you will have a clear, actionable framework for building your own Buffett-style strategy, one that empowers you to think like a business owner and make decisions with confidence and discipline. This journey will transform how you view the market, moving you from a passive spectator to a strategic participant. Table of Contents Part 2, Act 1, Rethinking Warren Buffett, about 3 sections. Section 1, the buy and forget fallacy. One of the most persistent and misleading myths about Warren Buffett is that he simply buys a stock and then forgets about it for 50 years. This buy and forget narrative is incredibly popular because it sounds so simple and effortless. It suggests that the secret to becoming a billionaire investor is to pick a handful of great companies like Coca-Cola, like American Express, lock those shares away in a vault and then go live your life only to return decades later to a massive fortune. It's a comforting bedtime story for investors, implying that success requires no ongoing effort, no re-evaluation, and no difficult decisions. This paints a picture of Buffett as a passive, almost Zen-like figure who has achieved his success through sheer inactivity. But this popular image couldn't be further from the truth, and it's the very first myth that Altucher's book sets out to dismantle. While Buffett certainly holds some of his favorite businesses for very long periods, his portfolio is not a static museum of corporate America. He is not a passive holder, he is an active manager of his capital. The idea that he just buys and forgets completely ignores the immense amount of work, analysis, and strategic thinking that goes into every single one of his decisions. His famous long-term holds are the result of constant re-evaluation, not the cause of his success. He holds them because they continue to meet his stringent criteria for value, not because of a blind, dogmatic belief in holding forever. The reality is that Buffett's success is built on a foundation of continuous analysis. He and his team at Berkshire Hathaway are constantly monitoring their holdings, assessing their performance and comparing them to new opportunities that arise in the market. If a company's long-term prospects weaken, if its management makes poor decisions, if its valuation becomes ridiculously high, Buffett is not afraid to trim his position or sell it entirely. This is a crucial distinction. The myth suggests that the initial purchase is the only decision that matters. The reality, as the book explains, is that investing is an ongoing process of evaluation, capital allocation, where every dollar must constantly justify its place in the portfolio. This buy and forget fallacy is not just inaccurate, it's dangerous for the average investor. It can lead to complacency, encouraging people to hold onto a stock even as its underlying business deteriorates simply because they believe they are following the Buffett way. It fosters a mindset of neglect rather than ownership. Imagine buying a house and then never checking on it again, never making repairs, never considering whether it's still the best place for you to live. That would be absurd, yet that is exactly what the buy and forget myth advocates for your financial assets. True Buffett-style investing requires active engagement, not passive hope. Section 2. The active hunter, not the passive farmer. To truly understand Buffett, we need to shift our mental model from a passive farmer to an active hunter who is constantly scanning the terrain. The farmer's success is largely dependent on things outside his control. Weather and the quality of the soil he chose years ago. The hunter, on the other hand, is proactive. He knows his territory, understands the behavior of his prey, and waits patiently for the perfect moment to strike. He doesn't just wander into the forest and hope for the best. He has a strategy. He is disciplined, and he is always ready to act decisively when the right opportunity presents itself. This active hunter analogy perfectly captures the essence of Buffett's real approach. He doesn't just sit in his office in Omaha waiting for good news to fall into his lap. He is voraciously reading, studying industries, analyzing financial statements, and talking to management teams. He is actively searching for businesses that fit his strict criteria. Companies with durable competitive advantages, competent and honest leadership, and most importantly, a stock price that is significantly below their intrinsic value. This is not a passive activity. It is an intense, intellectually demanding process that requires constant vigilance and a deep understanding of the business landscape. He is hunting for value, and that hunt never stops. This active approach extends beyond just buying. Buffett is also constantly thinking about capital allocation, deciding where to put his money to get the best return. He sees the capital within Berkshire Hathaway as a dynamic resource that needs to be deployed intelligently. Sometimes the best decision is to hold a fantastic business for another decade. Other times it might be to sell a fully priced stock to free up cash for a more attractive opportunity that has just appeared. For example, he has bought and sold airline stocks, trimmed positions in banks, and made huge bets on technology companies like Apple. All moves that reflect an active, not passive management style. This perspective is incredibly empowering for the individual investor. It means you don't have to feel helpless simply riding the waves of the market. Instead, you can adopt the mindset of a hunter. You can learn to identify the characteristics of a great business, develop the patience to wait for a fair price, and have the confidence to act when the time is right. The book teaches us that we shouldn't just be passengers in our financial journey. We should be the pilots. This involves doing the homework, staying informed about our investments, and always being on the lookout for a better opportunity. It's about taking control, just as Buffett does every single day. When the book uses the word trading in its title, it's crucial to understand the distinction between intelligent trading and mindless speculation. To many, trading conjures images of frantic day traders. To many, trading conjures images of people glued to their screens. To many, trading conjures images of buying and selling stocks. Buying and selling often follows fleeting chart patterns, or it follows news headlines, or it follows gut feelings. This is speculation, essentially a form of gambling. Speculators bet on price movements without understanding the asset's real value. They hope to buy at 10 and sell at 11, all without knowing if the business is worth 5 or 20. It's a game of chasing momentum, and it's a game most people lose. Intelligent trading, per Buffett, is the polar opposite. It is the disciplined act of buying, it is the disciplined act of selling, both based on rational calculation of intrinsic value. An intelligent trader is a value investor and also tactical. The decision to buy is not based on a hot tip or market hype, it's based on rigorous analysis. Analysis that shows the stock is on sale, trading far below true worth. The decision to sell is equally logical. triggered when price soars above intrinsic value, or when a business's fundamentals have permanently soured. Think of it this way: a speculator buys hoping price goes up. An intelligent trader buys because price is already too low versus real worth. The speculator focuses on price. The intelligent trader focuses on value. This is the fundamental difference. Buffett said, price is what you pay. Value is what you get. His whole strategy exploits the gap between price and value. He isn't trying to predict the market's next move. Instead, he profits from the market's mistakes, its moments of irrational fear, its moments of greed, moments that misprice a great business. This is what trade like Warren Buffett truly means. Trade based on facts, not feelings. Trade based on business fundamentals, not market noise. Execute buys and sells with the calm, calculated precision of a business owner, not the frantic energy of a gambler at a casino. Every trade is a strategic investment grounded in value and margin of safety. Adopt this mindset and you rise from mere speculator, tossed about by market whims, to a strategic investor who uses emotional swings to their advantage. It's a profound shift. Trading becomes a disciplined art. Now that we've debunked the myth of the passive buy and forget investor, we can start to build a more accurate picture of Buffett's real strategy. At its core, his approach isn't a simple one-step process. It's a dynamic three-part cycle that is constantly in motion. Buy, hold, reallocate. This framework is far more active and strategic than the popular narrative suggests. It's not just about finding a good company and holding on for dear life. It's about methodically identifying undervalued assets, patiently holding them as long as they remain great businesses at fair prices, and then intelligently reallocating that capital when the situation changes. This cycle is the engine that has powered Berkshire Hathaway's incredible returns for decades. The first pillar, buy, is all about acquiring wonderful businesses when they are trading at a significant discount to their true worth. This is the value investing foundation we've talked about. The second pillar, hold, is what most people associate with Buffett, but it's a conditional hold, not a blind one. He holds a business as long as it continues to execute, maintain its competitive advantage, and its stock price hasn't become absurdly overvalued. The holding period is the result of the business continuing to be a great investment, not a predetermined rule. It requires constant monitoring and re-evaluation to ensure the original reasons for buying still apply, which is an active, not a passive process. The third pillar, reallocate, is the most overlooked but arguably one of the most crucial parts of his strategy. This is where the trading aspect in its intelligent form comes into play. Reallocation means making the tough decision to sell a position or trim a position to free up capital for a better opportunity. This could happen for several reasons. Perhaps the stock has become wildly overvalued, meaning its future returns are likely to be poor. Or maybe the business fundamentals have deteriorated. Crucially, it could also happen simply because a new, even more compelling investment has appeared. This pillar ensures that capital is always working its hardest, moving from good ideas to even better ones. This buy, hold, reallocate cycle transforms investing from a static event into a dynamic process of capital management. It's the mindset of a CEO running a business, not a collector hoarding assets. A CEO constantly assesses every division of their company, investing more in high-performing areas and divesting from underperforming ones. Buffett treats his portfolio the same way. Each stock is a division of Buffett Inc., and it has to continuously earn its keep. Understanding this three-pillar framework is the first step to moving beyond the myth and starting to think and act like a truly strategic investor, ready to seize opportunities as they arise in the market. The first and most fundamental part of Buffett's strategy is buying the right thing at the right price. This sounds simple, but it's where most of the hard work is done. For Buffett, the right thing is a wonderful business. He's not interested in mediocre companies. A wonderful business has a durable competitive advantage, a moat. The moat protects it from competitors. It lets the company generate high returns on capital for years. Think of Coca-Cola, think of American Express's network effect. Think of Apple's ecosystem. Finding a great business is only half the equation. The other half is buying it at the right price. Buffett is a bargain hunter. He won't overpay for quality. He buys wonderful businesses when they're on sale. That often happens during market fear, or industry pessimism, or a temporary solvable company problem. He waits for prices well below intrinsic value. A superior business purchased at an inferior price. That's the secret. Buying a great company gives you business tailwinds. Buying at a discount gives you a margin of safety. If it's worth $100 and you pay $60, you have a $40 cushion. That cushion reduces downside risk. Buffett thinks downside first. I will say avoid losing money. The buy phase isn't a frantic scramble. It's slow, deliberate, disciplined. It requires deep research. It requires patience to wait, sometimes years. It requires courage to act when the opportunity arrives. Be a business analyst first, a stock market participant second. Buying quality at a discount sets the foundation for long-term success. While Buffett is famous for his long holding periods, his decision to sell is just as strategic and calculated as his decision to buy. The buy and forget myth ignores this critical step. Selling in Buffett's world is a logical act of capital reallocation. It's the final step that lets him lock in gains and redeploy into better ventures. As Altucher says, there are two logic-based reasons to sell, not panic or short-term noise. Reason 1, valuation no longer makes sense. The market gets overly excited and pushes price above intrinsic value. Buffett's strategy is about buying at a discount. When the discount flips to a premium, the investment thesis is inverted. Holding then means high risk and low reward. Prices tend to revert, so future returns can be mediocre or negative. Selling an overvalued stock ensures prudent risk management and profit harvesting. Reason 2, business fundamentals deteriorate. A company's moat might shrink because of new technology. A company's moat might shrink because of tougher competition. Management can start making poor decisions, destroying shareholder value. Or the whole industry can face a permanent structural decline. When the reasons you bought a wonderful business are gone, it's time to re-evaluate. Don't hold out of loyalty or nostalgia. Smart investors are unsentimental and cut losses early. Finally, opportunity cost. You must weigh what else you could do with that capital. At the absolute heart of Warren Buffett's entire philosophy lies a single powerful concept: intrinsic value. This is the bedrock upon which all his investment decisions are built. But what exactly is it? In the simplest terms, the intrinsic value of a business is the discounted value of all the cash that can be taken out of it during its remaining life. Think of it like this. If you were to buy a small local business like a coffee shop, you'd want to figure out how much profit it would generate for you each year from now until the day it closes. Intrinsic value is the total of those future profits, adjusted because $1 today is worth more than $1 10 years from now. It's the true economic worth of the business, separate from its fluctuating stock price. This separates a Buffett-style investor from a speculator. A speculator is obsessed with the stock price. An investor is obsessed with intrinsic value, knowing the stock price will gravitate toward it over the long run. Calculating intrinsic value isn't exact, it's an estimate, but a rational conservative estimate gives you a North Star. It provides an objective benchmark to compare either market price. Without a sense of true worth, you are flying blind at the mercy of market sentiment and crowd psychology. That's a dangerous way to manage money. Altucher's book says you don't need to be a Wall Street quant to do this. The goal is a reasonable range, not a penny-perfect figure. Is the business worth closer to 50 per share or 150 per share? Look at the company's historical earnings, its growth prospects, and the stability of its cash flows. Predictable, consistent profits make valuation easier. For example, a utility company or a dominant consumer brand. That's easier to value than a speculative biotech startup with no revenue. This is why Buffett stays inside his circle of competence, focusing on businesses he can understand and value confidently. Pursuing intrinsic value forces you to think like a business owner, not a gambler. It shifts focus from KK noise to the long-term health of the company. It asks the key question, if I had enough money, would I buy this entire business at today's price? If the answer is a resounding yes, because future cash flows offer a great return, you have likely found an attractive investment. This disciplined focus is the first and most critical step in trading like Warren Buffett. One of Warren Buffett's most famous quotes perfectly encapsulates his entire investment strategy. Price is what you pay, value is what you get. This simple sentence draws a bright, bold line between two concepts that most people mistakenly lump together. The price is the number you see flickering on your screen, the cost of one share of a company at this very moment. It is emotional, volatile, often irrational, driven by the daily news cycle, fear, and greed. Value is the intrinsic worth of the underlying business. It is rational, stable, and based on the company's long-term ability to generate cash. The core of Buffett's genius lies in his relentless exploitation of the gap between these two things. The market, in the short term, is a voting machine, tallying up popularity contests based on sentiment and momentum. A stock can become popular, its price can soar to dizzying heights, far beyond any reasonable measure of its true worth. Conversely, a stock can fall out of favor due to bad news or general pessimism, and its price can plummet far below what the business is actually worth. This is where opportunity lives. Buffett understands that popularity is fickle. Value is enduring. He ignores the voting machine, focuses on what the business will be worth over many years. Market swings will subside, price will align with underlying value. This is why price matters more than popularity. Chasing popular, high-flying stocks is a recipe for disaster. You're buying into the hype at its peak. You're paying a premium price which limits your upside and maximizes your downside. Instead, Buffett does the opposite. He seeks out unpopular, neglected, feared stocks only if they are wonderful businesses. He buys when others are panicking because price is most likely disconnected from value then. Buying quality on sale, not chasing momentum at a premium price. This mindset requires a contrarian streak and emotional discipline. When everyone is excitedly buying a stock, a Buffett-style investor is on the sidelines or considering selling. When everyone is panicking and selling, the investor sharpens their pencil, does their homework, and looks for bargains. Trust your analysis of a business's value over the market's temporary opinion reflected in price. Remember, price is just what you pay. Wait for price to offer extraordinary value in return. Section 3. The margin of safety, your shield against uncertainty. If intrinsic value is the North Star, then the margin of safety is the shield that protects you on your journey. This concept, originally taught to Buffett by his mentor Benjamin Graham, is the single most important principle for ensuring the preservation of capital. It is remarkably simple in theory. Only buy a stock when its market price is significantly below your estimate of its intrinsic value. You don't just want to buy a business for what it's worth, you want to buy it for far less than it's worth. This discount, or the gap between the intrinsic value and the purchase price, is your margin of safety. It's the cushion that protects you from bad luck, errors in judgment, and the unpredictable nature of the future. For example, let's say you analyze a company and conservatively estimate its intrinsic value to be $100 per share. The margin of safety principle dictates that you should not buy it when it's trading at $95 or even $85. Instead, you wait patiently until the market, in a moment of panic or neglect, offers it to you for $60 or $50. At that price, you have a substantial buffer. If your valuation was slightly too optimistic and the business is only worth $80, you still bought it at a discount. If the company hits a rough patch and its value temporarily dips to $70, you are still protected from a permanent loss. The margin of safety gives you room to be wrong. This principle is Buffett's secret to his #1 rule: never lose money. By insisting on a large discount at the time of purchase, he dramatically reduces the odds of a catastrophic loss. The upside will take care of itself. A great business bought at a cheap price will almost certainly deliver good returns over time. The primary focus is on protecting the downside. This is a defensive strategy, not an aggressive one. It prioritizes survival and risk management above all else. A speculator swings for the fences, hoping for a home run, but often striking out. Buffett aims to get on base consistently, knowing that is how you win the game over the long run. Building this shield requires two things: a rational estimate of value and the emotional discipline to wait for the price to drop far below it. This is often the hardest part for investors. It means watching a good company's stock go up and resisting the urge to chase it. It means having the courage to buy when headlines are terrible and fear is rampant in the market. But as Altucher's book emphasizes, this is the non-negotiable key to long-term success. The margin of safety is not just a theoretical concept, it is the practical implementation of a risk-averse mindset that transforms investing from a gamble into a calculated, high-probability endeavor. Section 1. The Power of Patience, Waiting for the Perfect Pitch. Warren Buffett has often compared investing to baseball, but with one crucial difference. In baseball, a batter must swing at strikes or be out after 3 strikes. In investing, there are no cold strikes. You can stand at the plate all day watching thousands of pitches, thousands of different stocks at different prices. They go by without you ever swinging. You can wait indefinitely for that one perfect pitch. A single extraordinary opportunity you understand completely. One with an incredibly high probability of success. That is the foundation of Buffett's legendary patience. It's not passive waiting, it's an active, disciplined choice to do nothing until everything lines up. Waiting, sometimes for years, is Buffett's competitive advantage. Most professional money managers are under pressure to perform, to generate returns, quarter after quarter. They feel compelled to swing at almost every pitch because their clients demand action, because their bosses demand action. That pressure leads to suboptimal decisions. Buying into mediocre companies at bad prices, chasing popular trends to feel like they're participating. Buffett, on the other hand, has structured Berkshire Hathaway to be immune to that pressure. He's content to sit on a growing pile of cash, sometimes for years, until the market serves up a fat pitch in his sweet spot. That waiting zone is where the hard work happens, intense preparation, not idleness. He is not on vacation, he is reading, studying industries, updating his valuations on a watch list of wonderful businesses, building deep understanding of the companies he might one day own. He's getting ready for the moment opportunity strikes. That preparation lets him recognize the perfect pitch instantly and gives him the confidence to act without hesitation. For average investors, build a watch list of companies you'd love to own, calculate a buy price for each, include a margin of safety, then you simply wait. This requires immense emotional fortitude. Resist the fear of missing out when markets soar, even when everyone else seems to be getting rich. Be comfortable with inactivity even when it feels wrong. As Altucher says, the market transfers wealth from the active to the patient. Cultivate the discipline to wait for that one perfect pitch. You shift the odds in your favor. Don't play the market's frantic game. Force the market to play yours. Wait for it to make a mistake you can capitalize on. Section 2. Acting decisively when opportunity knocks. While patience is the cornerstone of Buffett's timing strategy, it is only one side of the coin. The other side is the necessity of acting with bold, decisive conviction. Patience without the will to act is useless. When the market serves up that perfect pitch, a wonderful business at a ridiculous discount, it is not the time for hesitation. It is the time to swing, and to swing hard. Buffett makes enormous concentrated bets when odds are overwhelmingly in his favor. He doesn't nibble, he backs up the truck. That decisiveness comes from preparation during the waiting period. Example, American Express in the 1960s. Example, Coca-Cola in the 1980s. He had already done the homework. He knew the businesses inside and out. He understood their competitive advantages. He had a firm grasp of their intrinsic value. Market panic was the trigger he'd been waiting for. His pre-existing gave him conviction while others froze. He wasn't guessing, he was executing a prepared plan. For the individual investor, this means a clear rule. When a company on your watch list hits your predetermined buy price, you must act. This is where logic must overpower emotion. Your research has already confirmed it's a great business. Your valuation work has confirmed the price is a bargain. The fear and negative headlines that accompany a low price are the very reasons the opportunity exists. To hesitate now is to let the market's irrationality infect your decision making. Use a mechanical rule. If stock X falls below price Y, I will allocate Z% of my portfolio to it. To enforce discipline and remove emotion from execution. Extreme patience followed by bold action is what sets the masters apart from the amateurs. Most investors do the opposite. Impatient when they should wait, constantly chasing stocks, then fearful and indecisive when a true bargain appears. To trade like Buffett, you must invert this behavior. Learn to wait calmly through market mania, conserve your capital, and conserve your mental energy. Then, when panic creates a once-in-a-decade opportunity, have the courage and the conviction to step into the fray and buy with both hands, trusting the logical foundation you have so patiently built. It is critically important to understand the profound difference between strategic patience and simple, uninformed inactivity. The two may look identical from the outside, both not trading. Their mental states are worlds apart. Inactivity is born from fear, confusion, and neglect. It's the state of an investor who doesn't know what to do, is paralyzed by the headlines, or has simply forgotten about their portfolio. This type of idleness is passive and dangerous. It's the deer in the headlights syndrome. Frozen, unable to make a decision, whether to seize an opportunity or to cut a loss on a deteriorating business. Strategic patience, on the other hand, is an active and powerful choice. It is a conscious decision to refrain from action based on the logical conclusion that no current opportunity meets your strict investment criteria. A patient investor is not confused, They are clear and confident in their strategy. They know exactly what they are looking for, a great business at a great price, and they have concluded that it is not available at the moment. This state of being is not driven by fear but by discipline. It is the hunter sitting silently in the blind, fully alert and aware of their surroundings, waiting for the right moment. It is a position of strength, not weakness. One of the key mental rules to avoid slipping from patience into inactivity is to always be learning and preparing. A patient investor's downtime is spent productively, reading annual reports, studying new industries, refining their valuation models. They maintain a ready-to-buy watch list of pre-analyzed companies. An inactive investor, by contrast, is simply disengaged. They are not using the time to improve their knowledge or prepare for future opportunities. The easiest way to tell the difference is to ask yourself, if a great opportunity appeared tomorrow, would I be ready and able to recognize it and act on it? The patient investor's answer is a firm yes. The inactive investor's answer is likely I don't know. Ultimately, patience is purposeful waiting while inactivity is aimless drifting. To emulate Buffett, you must ensure your periods of doing nothing are intentional. You are not waiting because you are scared or lazy. You are waiting because you are a disciplined professional who refuses to lower their standards. This mindset protects you from the market's emotional traps. It prevents you from chasing bad pitches out of boredom and ensures you have the capital ready to deploy and the mental clarity ready to deploy when a truly great opportunity finally emerges from the noise. Patience is a deliberate strategy, while inactivity is a symptom of having no strategy at all. So, after patiently waiting, how do you know when the moment to buy has finally arrived? What are the actual signals that tell you a stock has become truly undervalued? These signals aren't in complex charts or mystical timing indicators. They're rooted in the relationship between stock price and business fundamentals. The most powerful signal is a sudden disconnect between market price and your calculated intrinsic value. That's the green light you've been waiting for. It stands out from the market noise. Common trigger: a general market downturn or correction. When the whole market sells off, even great businesses get dragged down. The market, in panic, often throws the baby out with the bathwater. A company's stock can fall 30 to 40% even if long-term prospects are unchanged. For the prepared investor, that's a flashing buy signal. It's a market-wide sale on high-quality assets, a rare chance to buy far below intrinsic value. Another key signal: company-specific bad news that's temporary and solvable. Example: misses quarterly earnings estimates. Example: short-term operational setback. Example: negative news cycle. The market often overreacts, punishing price more than long-term impact justifies. A Buffett-style investor distinguishes temporary stumbles from permanent impairments. Find a great company with a solvable issue that scared away Wall Street, and you've likely found a significant undervaluation signal. Finally, neglect. Some excellent businesses just aren't exciting. They may be in boring industries or slow growth industries. As a result, they can trade for years at low valuations despite steady, predictable earnings. This prolonged neglect creates persistent undervaluation. The signal is a quiet whisper, a solid, profitable business no one seems to notice. Identifying these overlooked gems is a hallmark of a deep value investor. Well, Warren Buffett's famous advice to be fearful when others are greedy and greedy only when others are fearful is perhaps the most concise summary of his buying strategy. While most investors see market fear as a sign to run for the hills, the book teaches us to view it as the ultimate buy signal. Fear is the engine that creates the best bargains. It causes people to act irrationally, to sell perfectly good assets at ridiculously low prices simply because they are scared of what might happen tomorrow. This widespread panic creates the very margin of safety that a value investor depends on. The greater the fear, the wider the gap between price and value, and therefore the greater the opportunity. Think about the major market crashes of the past. .com bust, 2008 financial crisis, COVID-20 plunge in 2020. These were periods of extreme palpable fear. The headlines were apocalyptic and the consensus view was that the world was ending. Yet, these moments turned out to be the single greatest buying opportunities of their respective decades. Investors who had the courage to be greedy while others were fearful were able to acquire shares in world-class companies at fire sale prices. Embracing fear doesn't mean being reckless, it means trusting your own rational analysis of a business's value when the rest of the market has lost its mind. To effectively use fear as an opportunity, you must separate the emotion from the reality of the business. The market's fear might be about a recession, a political event, or an industry-wide panic. The critical question you must ask is, does this event permanently damage the long-term earnings power of this specific company? In many cases, the answer is no. A global pandemic doesn't change the fact that people will still drink Coca-Cola or use their iPhones in 5 years. A recession doesn't destroy the long-term value of a dominant railroad or an insurance company. When you can logically conclude that the business will survive and thrive, the fear-induced low price is a gift. This requires you to cultivate a contrarian mindset and a strong emotional stomach. It's not easy to click the buy button when your portfolio is bleeding red and every expert on television is predicting doom. This is why the preparation we discussed earlier is so vital. Your pre-calculated intrinsic value and your buy price checklist act as an anchor of logic in a sea of emotion. When you see others panicking, don't let their fear become your fear. Instead, let it be your signal to start hunting for bargains, to be the calm, rational buyer in a market full of panicked sellers. That is how you truly turn fear into your greatest ally. Okay. Section 3. The Ultimate Buy Checklist. Fundamentals over headlines. Driven by logic, not fear or hype. Use a clear step-by-step checklist. Prioritize deep business fundamentals over fleeting headlines. Before buying, answer a series of critical questions. This systematizes your decision making. It acts as a final filter, stopping impulsive mistakes. First part, the quality of the business. Can you easily explain how the company makes money? Does it have a durable competitive advantage? Oh, management competent and honest? Does it have a long history of consistent earnings? If you can't confidently say yes, stop. No matter how cheap the stock seems, price alone won't fix a low quality business. Second part, valuation and price. Have you calculated a conservative estimate of intrinsic value? Is the current price trading at a significant discount, a margin of safety? Why is the stock cheap right now? Is it a temporary problem or a permanent one? You must be able to articulate a clear, logical reason for the mispricing. Finally, review your own position. Is this inside your circle of competence? How does it fit your overall portfolio strategy? Are you prepared to hold long-term even if the price goes down after you buy? Subordinate screaming headlines to steady business analysis. Think like a business owner, not a gambler. This is the final city. Say it's the right time to buy. Table of contents. There's a part 7, act 6, when to sell. Section 1, the 2 cardinal sins, when fundamentals change. Knowing when to buy is only half the battle, knowing when to sell is the other, often more difficult half. The buy and hold forever myth leads many to believe that selling is a sign of failure or impatience. However, as Altucher's book makes clear, strategic selling is a critical component of intelligent portfolio management. One of the most important reasons to sell a stock has nothing to do with its price and everything to do with the underlying business itself. You must sell when the fundamental reasons you bought the company are no longer valid. This is not an emotional decision based on market noise. It is a cold, hard, logical assessment of business reality, protecting your capital from a deteriorating situation. The first cardinal sin that should trigger a sell decision is the erosion of the company's competitive advantage or its moat. You originally bought the business because it was special, protected from competitors by a strong brand, a network effect, a cost advantage, or some other durable edge. If you see clear evidence that this moat is shrinking, a disruptive new technology, a fierce new competitor, change in consumer behavior, then the company is no longer the wonderful business you once owned. Holding on out of nostalgia as its competitive position weakens is a recipe for permanent capital loss. Recognizing that the magic is gone and selling is a disciplined act of risk management. The second cardinal sin is a decline in the quality and integrity of management. When you buy a stock, you are entrusting your capital to the company's leadership team. Buffett places enormous emphasis on investing alongside managers who are both talented and trustworthy. If a new CEO takes over and begins making reckless acquisitions, taking on too much debt, or acting in ways that destroy shareholder value, it is a massive red flag. Similarly, if you discover that management is dishonest or is enriching itself at the expense of shareholders, the foundation of trust is broken. You can no longer be a passive partner in such an enterprise. Selling is the only logical course of action. These two fundamental changes, a weakening moat or a degradation of management, are non-negotiable sell signals. They indicate that the company's long-term earnings power is likely impaired. The stock price may not have reacted yet, but the underlying value is already in decline. A smart investor acts preemptively, selling the business before the market fully recognizes the problem and punishes the stock price. This requires you to stay informed about your holdings, to read the annual reports, and to continually ask yourself, if I didn't own this stock today, would I buy it based on what I now know about the business? If the answer is no, it's time to sell. Section 2. The happy problem when valuation becomes extreme. The second major reason to sell is what you might call a happy problem. This occurs when the market completely falls in love with a stock you own, pushing its price to an extreme and irrational valuation. The stock is no longer a bargain, it's a bubble. You bought the company at a significant discount to its intrinsic value, and now the market's manic enthusiasm has turned that discount into a massive premium. While it might feel good to watch the price climb higher every day, a disciplined Buffett-style investor recognizes this as a signal of high risk and diminishing future returns. It is time to consider taking profits off the table. Remember, the entire strategy is built on the principle of price is what you pay, value is what you get. When you first bought the stock, you paid a low price and got a lot of value. Now, the situation has reversed. A new buyer at today's inflated price is paying a great deal and getting very little intrinsic value in return. For them, the margin of safety is gone. In fact, it has become a margin of peril. By holding on at these levels, you are effectively endorsing this new risky proposition. Your potential for future gains has shrunk dramatically while your potential downside, the risk that the price will eventually fall back to a more rational valuation, has grown enormously. Deciding to sell a winner is psychologically difficult. The fear of missing out on even more gains can be paralyzing. The stock has been good to you and it's tempting to believe it will go up forever. This is where logic must triumph over greed. You must return to your original valuation work. If you estimated the business was worth $100 per share and the market is now pricing it at $200 or $250, you have to acknowledge that the price has become detached from reality. Selling all of your position or selling part of your position is not a betrayal of a great company. It is the logical conclusion of a successful investment. You are harvesting the rewards of your initial correct analysis. This is the essence of trading like Buffett. You buy based on value and you sell based on value. When the market offers you a price that far exceeds your own rational estimate of a company's worth, it is making you an offer that is too good to refuse. A smart business owner would sell the entire company if someone offered them double what it was worth. As a shareholder, you should think the same way. Selling a wildly overvalued stock allows you to lock in your profits, reduce your risk, and most importantly, free up capital that can be redeployed into the next undervalued opportunity that comes along. Section 3. The ultimate rebalancing act, opportunity cost. The final and perhaps most advanced reason to sell is opportunity cost. Every dollar you have invested in a stock is a dollar you cannot invest somewhere else. Your portfolio is not static, it is a dynamic pool of capital that should always be working for you. Constantly compare your current holdings not just against their own merits, but against every other potential investment. Sometimes you must sell a perfectly good investment because you found a truly great one. This is the ultimate act of capital reallocation. Imagine you own stock A. It's a solid company bought at a fair price, expected to return about 8% per year. It's a perfectly acceptable investment. Then you find stock B equally high quality, but trading at a massive discount due to temporary market panic. Your analysis suggests stock B could return about 15% per year with similar or even lower risk. Holding stock A now has an opportunity cost of about 7% per year, the gap between stock B and stock A. Be ruthlessly objective about your portfolio. There is no room for emotional attachment. A stock is not a friend or a family member. It is a vehicle for generating returns. If a better vehicle arrives, you must switch as the manager of your capital. This is what Buffett does at Berkshire Hathaway. He weighs current holdings against new ideas, buying an entire company, buying a block of common stock, or buying a special type of bond. He deploys capital for the highest risk-adjusted return, not passive buy and forget. Active strategic management. Keep learning, keep hunting for new ideas. Maintain a shopping list of wonderful businesses you'd love to own at the right price. When one appears at an exceptional price, have the discipline to sell a less attractive holding to fund it. Your portfolio gets upgraded as capital moves from good ideas to your very best ideas. It is the final crucial step in ensuring your money is always positioned for maximum long-term success. Section 1. The first rule: avoid permanent loss of capital. Warren Buffett has two famous rules for investing. Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. This isn't just a clever saying, it is the absolute cornerstone of his investment philosophy. It is the single most important principle for long-term success. While many investors chase gains, Buffett is obsessed with avoiding losses. A large loss is far more damaging to long-term wealth than missing a temporary gain. A 50% loss requires a 100% gain to recover, a mathematical hole that's hard to climb out of. Capital preservation is paramount. Understand what Buffett means by losing money, not a temporary drop in a market downturn. Volatility is normal. He means permanent loss of capital. This happens when a business is fundamentally damaged or when you vastly overpay for it. That kind of loss destroys wealth forever. His strategy, insisting on a margin of safety and focusing on high-quality businesses protects against this outcome, is the central pillar of his risk control system. How do you apply it? First line of defense, margin of safety. Buy a business for significantly less than intrinsic value to create a buffer. If your analysis is slightly off or the business stumbles, the discount protects your principal. Second line of defense, invest only in businesses you understand. Stay inside your circle of competence. That prevents uninformed bets on speculative ventures. You stick to what you know, reducing fatal mistakes. The never lose money mindset shifts how you view risk. For many, risk X volatility or missing a hot stock. For Buffett-style investors, risk as probability of permanent loss. Prioritizing avoidance of that risk pushes you towards safer, rational decisions. Stop chasing speculative home runs and focus on consistent, high-probability base hits. This defensive approach protects capital and is the surest path to exceptional long-term gains. Section 2. Concentration versus diversification. The Buffett paradox. When it comes to managing risk, most financial advisors preach the gospel of diversification. They tell you to spread your money across dozens or even hundreds of stocks, so that if one company fails, it won't have a major impact on your overall portfolio. This "don't put all your eggs in one basket" approach is sensible advice for investors who don't have the time or inclination to do deep research. It's a form of risk control through ignorance. Since you don't know which companies will do well, you buy a little bit of everything. This method will protect you from ruin, but it will also guarantee that your returns will be mediocre, forever tethered to the market average. Warren Buffett, however, practices the polar opposite. He famously stated that diversification is protection against ignorance. He is a strong advocate for a concentrated portfolio where you put large amounts of your capital into a small number of your very best ideas. His reasoning is simple. True once in a decade opportunities are rare. When you find one, you should bet big. Spreading your money thinly across 50 different stocks, including your 50th best idea, only dilutes the returns from your very best ideas. A concentrated approach allows your best insights to have a meaningful impact on your wealth. This creates what seems like a paradox. How can concentrating your bets be a form of risk control? For Buffett, the risk is not in how many stocks you own, but in how well you know the businesses you own. He would argue that it is far riskier to own a tiny piece of 50 companies you know nothing about than it is to own a large piece of 5 companies you understand inside and out. The deep research and the strict criteria, durable moat, great management, and a huge margin of safety are what truly control the risk. The concentration is simply the reward for having done that work. It is an expression of extreme confidence in your analysis. For the individual investor, the book suggests a balanced approach. You may not have the confidence to put 40% of your net worth into a single stock like Buffett does. However, you can still apply the principle by avoiding diversification, owning too many stocks just for the sake of it. Instead of 50 stocks, perhaps you focus on your best 10 to 15 ideas. This is concentrated enough for your good decisions to matter, but diversified enough to protect you from a single catastrophic error. The key is that every single company in your portfolio should be one that you have researched thoroughly and in which you have strong long-term conviction. Section 3. Downside First Thinking, Protecting Your Portfolio. At the heart of Buffett's approach to risk is a mental framework that can be described as a downside first thinking. Before he ever gets excited about how much money an investment could make, his first and most pressing question is, how much can I lose? He rigorously analyzes all the potential things that could go wrong. What if a recession hits? What if a new competitor emerges? What if the CEO makes a terrible decision? He tries to imagine a worst case but still plausible scenario for the business. Only after he is comfortable that the investment can withstand these pressures and that his risk of permanent loss is minimal does he even begin to consider the potential upside. This is the complete opposite of how most investors think. The average person is drawn to a stock by a story of explosive growth and unlimited potential. They focus almost exclusively on the upside, imagining all the ways the stock could double or triple in price. They fall in love with the potential reward and spend very little time thinking about the potential risk. This upside first thinking is a recipe for disaster because it makes you blind to the dangers that lie beneath the surface. You end up taking on far more risk than you realize, often paying a high price for a speculative story with a low probability of success. Adopting a downside-first mindset is like being a professional engineer building a bridge. The engineer's primary concern is not how beautiful the bridge will look, but ensuring it will not collapse. They build in redundancies and safety factors, designing it to withstand forces far greater than it will likely ever face. Buffett invests in the same way. The margin of safety is his engineering safety factor. His focus on strong balance sheets and low debt is his way of ensuring the business can withstand economic storms. His insistence on a durable moat is his way of ensuring the business structure itself is sound and can't be easily toppled by competitors. This protective thinking should be applied to your entire portfolio. You can create simple protective steps to shield your capital. For example, setting a rule that you will never invest more than a certain percentage in any single industry can protect you from sector-wide collapses. Having a rule to avoid companies with high levels of debt can protect you from bankruptcies during a recession. By consistently asking what's the worst that can happen and making decisions that minimize that worst-case outcome, you build a resilient all-weather portfolio. The upside will tend to take care of itself if you are diligent about protecting the downside first. Table of Contents, Part 9, Act 8. Using market volatility to your advantage, about 3 sections. Section 1. Volatility isn't risk. Befriending Mr. Market. To most investors, volatility, the dramatic up and down swings in stock prices, is synonymous with risk. It feels scary and dangerous. A day when the market drops 3% sends a jolt of fear through the average person, making them question their investments and consider selling everything. Warren Buffett, however, holds a radically different view, one that is central to his success. He believes that volatility is not risk. The true risk, as we've established, is the permanent loss of capital. Volatility, on the other hand, is merely the symptom of the market's short-term mood swings. It is the noise, not the signal. For a disciplined investor, these price fluctuations are not a threat to be feared, but an opportunity to be embraced. It's the very thing that creates the bargains he loves to find. To explain this concept, Buffett uses a brilliant allegory about a business partner named Mr. Market. Imagine you own a piece of a private business and every single day your manic depressive partner Mr. Market comes to you and offers to either buy your share or sell you his at a specific price. Some days he is euphoric and wildly optimistic, offering to buy your share at a ridiculously high price. Other days, he is utterly despondent and panicked, offering to sell you his share for pennies on the dollar. The key is that you are under no obligation to trade with him. You can happily ignore his silly offers day after day, waiting for him to do something foolish. This is exactly how a Buffett-style investor should view the stock market. It is not a source of wisdom to be followed, but a manic depressive partner to be exploited. When the market is volatile and prices are plunging, that is simply Mr. Market in one of his panicked moods, offering you a fantastic bargain. You, the rational business owner, should be delighted by his pessimism and consider buying more from him. When the market is soaring and prices are absurdly high, that is Mr. Market in a state of euphoria, offering you a foolishly high price for your shares. In that case, you might consider selling to him. Volatility is what gives you these opportunities on a silver platter. The mistake most people make is letting Mr. Market's mood dictate their own. They feel euphoric when he is euphoric and they panic when he panics. They let his irrational short-term price quotes influence their own long-term judgment about the business's true value. To trade like Buffett, you must learn to detach yourself emotionally from these daily swings. You must see volatility not as a measure of risk, but as a measure of opportunity. The more volatile the market, the more chances Mr. Market will give you to buy wonderful businesses at absurdly cheap prices. He is not your guide. He is your servant. Section 2. How fear and greed create mispricing. The engine that drives market volatility and creates the opportunities we seek, is fueled by two powerful primal human emotions, fear, greed. These emotions are deeply wired into our psychology and, when it comes to money, often overwhelm rational thought. The entire field of behavioral finance studies how these biases cause predictable, systematic errors. Buffett understood this intuitively long before it became an academic discipline. His strategy is, in many ways, a system designed to exploit irrational behavior, driven by the collective fear and greed of market participants personified by Mr. Market. Greed is the driving force behind market bubbles, stealth, awareness, mania, blow-off, top, crash. It begins when a stock or industry captures the public's imagination, fueled by a compelling story of revolutionary change and unlimited profits. As the price starts to rise, early investors make money and their success stories spread. This triggers the fear of missing out in others. People abandon their analytical judgment and start buying the stock simply because it is going up, hoping to get rid quick. This herd behavior creates a self-reinforcing cycle, pushing prices to levels completely disconnected from the underlying business's intrinsic value. This is the moment of maximum greed, and for a value investor, it is a time of maximum risk and a potential selling opportunity. On the other side of the emotional spectrum is fear. Fear takes hold when the bubble inevitably pops or when some unexpected bad news, a recession, a pandemic, a financial crisis. The optimism of yesterday is replaced by the panic of today. Investors who bought at the top are now facing steep losses. The emotional pain of losing money triggers a flight or fight response, and most choose flight. They sell indiscriminately, desperate to stop the pain, without regard for long-term value. This herd-like panic creates a downward spiral, pushing prices far below any rational measure of intrinsic value. This is the moment of maximum fear. This is where the magic happens for a prepared investor. The mispricing created by widespread fear is the greatest gift the market can offer. It allows you to purchase shares in excellent companies from panicked sellers at prices that would be unthinkable in a normal, rational market. Buffett's famous advice to be greedy when others are fearful is a direct instruction to be the calm, rational buyer in a world of emotional sellers. By understanding that fear and greed are the forces creating these price dislocations, you can learn to see market volatility not as chaos, but as a predictable pattern of human behavior that you can use to your distinct advantage. History is filled with spectacular examples of how using market volatility and buying during extreme fear can create massive wealth. These aren't theoretical. They're proven strategies Buffett used again and again. One famous early example, American Express during the 1963 salad oil scandal. A customer defaulted on huge loans secured by vats of salad oil, mostly water. The market panicked, fearing bankruptcy. The stock was cut in half. Buffett did his homework instead of panicking. He went to restaurants, he went to banks, he saw customers still using traveler's checks, he saw merchants still accepting credit cards. He realized the core business was fine, the warehousing issue was small. The market's fear created a huge disconnect from long-term value. While others sold in terror, Buffett invested 40% of his partnership into Amex, a huge concentrated bet. The stock later recovered and soared. Fast forward, 2008 financial crisis. The banking system looked close to collapse. Bank stocks were being decimated. In September 2008, Buffett invested $5 billion in Goldman Sachs, more than a stock purchase, a vote of confidence in the American financial system. He received preferred stock with a hefty 10% dividend, plus warrants to buy common stock at a very low price. The deal existed because Goldman was desperate and fear was rampant. He was greedy when others were terrified. These examples give a clear guideline for individual investors. When a crisis hits, or if it's specific to a company or if it affects the entire market, that's not the time to run. That's the time to start researching. Ask yourself, is this problem temporary or permanent? Will this company or this industry exist and be profitable in 5 or 10 years? If yes, fear-induced low prices are a powerful buy signal. Train yourself to be a calm, analytical buyer during the storm. You're emulating Buffett's strategy and turning market chaos into advantage. A common question that arises is whether Buffett's old-fashioned value-based principles are still relevant in today's modern, fast-paced markets. We live in an age of high-frequency trading, meme stocks, cryptocurrency, and a 24/7 news cycle that bombards us with information and encourages rapid-fire decisions. It's easy to look at this chaotic environment and conclude that the slow, patient approach of an Omaha-based octogenarian is hopelessly outdated. The market seems to be driven by different forces now, by social media trends, by complex algorithms, and by a relentless focus on short-term technological disruption rather than long-term stable earnings. Technology has undoubtedly changed the speed of information, but has it changed the fundamental nature of what makes a good investment? The book argues compellingly that these principles are more important now than ever before. The core tenets of Buffett's strategy, buy businesses you understand, insist on a margin of safety, think long-term, and let fear and greed be your servants, are not dependent on the speed of the market. They are timeless principles of business and human psychology. In fact, the very speed and noise of modern markets often create even more opportunities for the disciplined, patient investor. The increased focus on quarterly results and a constant news churn leads to more short-term volatility, which means Mr. Market has more frequent manic and depressive episodes, offering up more fat pitches to those willing to wait for them. The principles remain the same, but their application might require some modern adjustments. For example, the mode of a business might look different today. 100 years ago, it might have been a railroad's physical tracks or a factory's scale. Today, a durable competitive advantage is more likely to be found in intangible assets like network effects. Think Facebook or Amazon. Strong brand loyalty in a crowded digital space. Think Apple. Or proprietary technology and intellectual property. The job of the modern Buffett-style investor is to learn how to identify these new forms of moats while still applying the same rigorous standards of valuation and management quality. The what, the search for a durable advantage, hasn't changed, only the where you find it. Ultimately, the frenetic pace of today's market is precisely why a calm, logic-based anchor is so crucial. The faster and noisier the world gets, the greater the advantage for those who can slow down, think independently, and focus on the long-term fundamentals that truly drive business value. The modern market's obsession with speed and novelty creates endless distractions and encourages emotional decision-making. By sticking to the time-tested principles of value investing, you are not being outdated. You are building a powerful firewall against the irrationality of the crowd, allowing you to navigate the complexities of the modern financial world with clarity and confidence. While Buffett is most famous for picking individual stocks, the underlying logic of his strategy can be powerfully applied to other types of investments, including those that are more accessible to the average investor, like exchange-traded funds, ETFs. Diagram Buffett's logic. Individual stocks industry ETFs, special situations. An ETF allows you to buy a basket of stocks such as all the companies in the S&P 500 or a specific industry like technology or healthcare. A Buffett-style approach to ETFs involves applying the same principles of valuation and timing. Instead of asking if an individual company is cheap, you ask if an entire sector or market is cheap relative to its long-term earnings potential. This can be a great way to make a broad bet on a recovery without needing to pick the single best company. For example, during a major market crash like the one in 2008 or 2020, you might not know which specific bank or airline will be the ultimate winner. However, you can make a rational judgment that the entire banking system or travel industry will eventually recover and return to profitability. In this scenario, buying a broad banking ETF like XLF or an airline ETF like Jets when the sector is plagued by extreme fear can be a fantastic application of Buffett's "be greedy when others are fearful" mantra. You are buying an entire industry at a moment of maximum pessimism, creating a significant margin of safety for yourself without the company's specific risk of picking a loser. The logic also extends to what Buffett calls special situations or workouts. These are unique corporate events like mergers, acquisitions, spin-offs, or bankruptcies, where the outcome of the investment depends on the details of the event rather than the general direction of the stock market. For instance, when one company announces it is acquiring another for a set price per share, the target company's stock will usually trade at a small discount to the acquisition price until the deal officially closes. An investor can buy the stock, wait for the deal to finalize, and capture that small, predictable spread. This is a classic Buffett-style investment, a high-probability short-term return that is disconnected from market volatility. For the individual investor, this means broadening your perspective beyond just buying and holding common stocks. You can use the core principles, find value, demand a margin of safety, and exploit market irrationality across a wider range of opportunities. Whether it's buying a country-specific ETF after a political crisis has scared investors away, or analyzing a simple merger arbitrage situation, the goal is the same. You are using logic and research to find situations where the potential reward significantly outweighs the potential risk. This flexible application of the core philosophy is a key part of how Buffett has been able to consistently find value in ever-changing markets for over 70 years. Section 3. Staying sane in a noisy market, your rationality shield. Perhaps the greatest challenge in applying Buffett's logic to modern markets is not analytical but psychological. We are constantly inundated with a fire hose of information, opinions, and alerts from financial news networks, social media, and trading apps. This endless stream of noise is designed to provoke an emotional response and encourage constant activity. It creates a sense of urgency, making you feel that you must act now or risk missing out. This environment is the natural enemy of the patient, long-term, rational investor. Therefore, building a rationality shield to protect yourself from this noise is one of the most critical skills you can develop. The first layer of this shield is to consciously and deliberately limit your information intake. You do not need to watch financial news all day or check your stock portfolio every 5 minutes. This constant monitoring does not make you a better investor, it just exposes you to more volatility and more emotional triggers from Mr. Market. Instead, schedule specific, limited times to review your portfolio and catch up on relevant business news, perhaps once a week or once a month. Focus on primary sources like company annual reports and investor presentations rather than the sensationalized commentary of television pundits. This creates a buffer of silence that allows for clear, rational thought. The second layer of your shield is to rely on a system of rules and checklists. As we have discussed, your predetermined buy and sell rules are your anchor in an emotional storm. When the market is crashing and your gut is telling you to sell everything, your checklist forces you to ask logical questions. Has the company's moat been damaged? Is management still acting rationally? Is the stock now even cheaper and a better buy? This system externalizes your decision-making process, moving it from the realm of fickle emotion to the domain of disciplined logic. It provides a consistent framework that helps you stay the course when your willpower is being tested by market chaos. Finally, the strongest part of your rationality shield is a deep, fundamental understanding of your own investments. If you have done the work and truly understand why you own a particular business, you will be far less likely to be shaken out of your position by short-term noise or price declines. Your conviction will be based on your own research into the company's long-term value, not on the fleeting opinions of the crowd. This deep-seated confidence allows you to view market volatility with a sense of calm detachment and even opportunism. In a world that profits from your emotional reactions, your ability to remain rational is your ultimate and most sustainable competitive advantage. Stay calm and stick to your plan. Section 1. The Constitution of You, Creating Your Personal Rules. We have now journeyed through all the core principles of Buffett's strategy, from valuation, margin of safety, timing, and risk control. The final and most crucial step is to synthesize all this knowledge into a personalized strategy that works for you. The goal is not to become a carbon copy of Warren Buffett, but to build your own robust framework inspired by his logic. This begins with creating a personal investment constitution. A clear, written set of rules that will govern all of your investment decisions. This document is your shield against emotional error and your roadmap to disciplined action, ensuring you act with purpose rather than impulse. This constitution should be explicit and unambiguous. It needs to define your entire process from start to finish. For example, your rules for buying should be clearly stated. I will only buy a stock if I explain the business to a 10-year-old, if it has a consistent operating history of at least 10 years, if its debt is manageable, and if it is trading at least 30% below my conservative estimate of its intrinsic value. By writing this down, you create a non-negotiable filter. When you are tempted by a hot stock tip, you can refer back to your rules. If the stock doesn't meet your criteria, the decision is simple, you pass. Similarly, your selling rules must be just as clearly defined. Your constitution should outline the specific conditions under which you will exit a position. I will sell a stock if its price rises to 25% above my estimate of its intrinsic value, if its fundamental competitive advantage shows clear signs of erosion, or if I find a new investment that offers a demonstrably better risk-adjusted return. These rules prevent you from holding on to a winner for too long out of greed or holding a loser for too long out of hope. They force you to make selling a logical, system-driven decision rather than an emotional one. This process of writing down your rules does something powerful. It forces you to truly think through your strategy and commit to it. Your personal constitution becomes your boss, holding you accountable to the rational investor you aspire to be, especially during times of market stress. It is your personalized playbook adapted to your risk tolerance, your circle of competence, and your long-term financial goals. It is the ultimate tool for turning the timeless wisdom of Warren Buffett into a practical, repeatable process that you can use to build wealth for the rest of your life. It is the foundation upon which your entire investment house will be built. So write it down and follow it. Section 2. The Art of Sizing, Allocating Your Capital Wisely. Once you have your set of rules for what to buy and sell, the next critical component of your strategy is position sizing. This is the art and science of deciding how much of your capital to allocate to any single investment idea. It's a crucial element of risk management and a major determinant of your long-term returns. You could have a brilliant strategy for picking stocks, but if your position sizing is poor, you can still end up with mediocre results or even catastrophic losses. Buffett himself is a master of this, making enormous concentrated bets on his highest conviction ideas, which has been a key driver of his success over the decades. The book advises against Buffett-level concentration, but strongly encourages moving away from thoughtless diversification. A common mistake, allocating the same amount to every stock, treating your 15th best idea the same as your absolute best idea. Size positions based on conviction and opportunity quality. Exceptional opportunity, larger allocation than a merely good idea. That ensures your best insights materially move portfolio performance. Use a tiered system for position sizing. Standard position for a good company at a fair price 5%, high conviction core position 10% or even 15%. Speculative starter positions 1% or 2%. This framework gives disciplined structure based on risk and potential reward. Write your position sizing into your investment constitution. Predefine the max percentage you're willing to risk on any single stock and the conditions. This prevents excitement-driven, oversized bets that could cripple your portfolio. Smart position sizing finds the right balance. Be aggressive when certain, but protect yourself when you're wrong. It's a critical skill for serious investors, and be thoughtful about how much you bet. Section 3. The Flexible Mindset, Long-Term Vision, Tactical Action. The final piece of the puzzle in building your own Buffett-style strategy is cultivating the right mindset. This is a delicate balance between having a firm long-term vision and maintaining the flexibility to take tactical action. The long-term vision comes from thinking like a business owner. When you buy a stock, you should be prepared to hold it for many years, as if you were buying a piece of a private company. You should be focused on the company's ability to grow its earnings and intrinsic value over a 5 or 10-year horizon, not on what the stock price will do in the next 3 months. This long-term perspective is your anchor, keeping you grounded during periods of market volatility. However, this long-term vision must not morph into rigid, dogmatic inaction. This is where tactical flexibility comes in. while you are prepared to hold for the long term. You must remain an active and engaged owner of your assets, constantly monitoring your holdings, re-evaluating their intrinsic value, and comparing them to new opportunities that the market presents. It's the difference between being a patient investor and a passive one. You are always on the lookout, ready to act decisively when your rules are triggered, a rule to buy more, a rule to trim a position, or a rule to sell entirely and reallocate your capital. This blend of long-term patience and short-term opportunism is the true essence of what it means to trade like Buffett. You are not a day trader chasing every wiggle on the chart, nor are you a buy-and-forget investor who neglects their portfolio for decades. You are a strategic operator, a capital allocator. You have the patience to hold a wonderful business for years as it compounds in value, but you also have the tactical awareness to sell it when it becomes wildly overvalued, or to take advantage of a market crash to add to your best ideas at bargain prices. It is a dynamic and intellectually engaging process. This flexible mindset is what allows you to thrive in any market environment. During bull markets, your long-term vision helps you resist the temptation to sell your winners too early. During bear markets, your tactical flexibility allows you to go on the offensive, using the market's fear as your opportunity to acquire great assets cheaply. By combining the steady hand of a long-term owner with the sharp eyes of an opportunistic trader, you create a powerful all-weather strategy that can adapt and succeed over the full course of your investing life, turning market chaos into your personal field of opportunity. Section 1. The core lessons, your new investing compass, As we reach the end of our journey through James Altucher's Trade Like Warren Buffett, it's time to distill everything we've learned into a clear and powerful conclusion. We began by dismantling the pervasive myth of Buffett as a passive buy-and-forget investor. In its place, we constructed a far more accurate model, that of a strategic, active, opportunistic capital allocator. This entire exploration can be boiled down to a handful of core, timeless lessons. Visual compass, 4 directions: price, value, logic, patience. The first and most fundamental lesson is that price matters immensely. The price you pay for an asset is the single greatest determinant of your future returns. Price is what you pay. Value is what you get. The second lesson, value beats hype. A successful investment is not about chasing popular narratives or hot trends. It's about the disciplined pursuit of wonderful businesses the market has temporarily mispriced. Your profits are made by patiently waiting for the crowd to make a mistake, then acting with conviction. The third core lesson, logic must always beat emotion. The market is a battlefield of fear and value and greed. Your greatest advantage is remaining rational when others are not. Be greedy when others are fearful. Be fearful when they are greedy. This is achieved not by willpower alone, but through checklists and predefined rules that anchor decisions in analysis. Finally, the fourth lesson, patience creates opportunity. The market rewards those who wait for the perfect pitch, who are content to do nothing until a truly extraordinary opportunity presents itself. These 4 principles form the unshakable foundation of the Buffett-style strategy. Simple to understand but requiring immense discipline to implement. By internalizing these lessons, price determines return, value is your guide, logic is your shield, patience your greatest weapon. You cease to be a gambler tossed by the market and become a strategic operator who uses volatility to your advantage. This is the ultimate transformation the book offers. Section 2. The Owner's Mindset. Your path to discipline. Beyond the specific tactics of buying and selling, the most profound shift that this strategy demands is the adoption of an owner's mindset. This is the intellectual and emotional anchor that makes disciplined, rule-based investing possible. When you stop thinking of yourself as someone who plays the stock market and start thinking of yourself as a part owner in a collection of real businesses, your entire perspective changes. You are no longer concerned with the daily meaningless fluctuations of stock prices. Instead, your focus shifts to the long-term health, profitability, and competitive strength of the companies you own. This is the true meaning of thinking like Warren Buffett. An owner is not panicked by a bad quarter or a negative news headline. They are concerned with the long-term trajectory of the business's earning power. An owner does not buy a stock based on a hot tip or a chart pattern. They invest their capital after careful study and analysis as if they were buying the entire company. This mindset naturally fosters the patience required to hold great businesses through market downturns and the emotional fortitude to ignore the short-term noise that sends speculators into a panic. It is the very source of the discipline that this strategy requires, grounding your actions in the tangible reality of business fundamentals rather than the abstract chaos of market sentiment. This owner's mindset is what makes rule-based investing feel natural rather than restrictive. Your investment constitution, your personal set of buy, sell, and sizing rules is no longer just an arbitrary list of constraints. It becomes the formal expression of your philosophy as a prudent business owner. Your rule to only buy with a margin of safety is simply you, as an owner, insisting on a good deal. Your rule to sell when a company's moat is eroding is you, as an owner, recognizing that one of your assets is deteriorating and needs to be replaced. Every rule is a reflection of sound business judgment, making it far easier to adhere to them with unwavering consistency. Ultimately, this is the path away from speculation and toward true investing. It means you take responsibility for every decision, basing it on your own research and analysis. You are an active participant in your financial future, not a passive bystander hoping for the best. By cultivating this deep-seated owner's mindset, you build an unshakable foundation of discipline. You learn to trust your own judgment over the roar of the crowd, to prioritize the preservation of your capital, and to view every investment decision through the clear, rational lens of a business proprietor. This is the final essential key to unlocking the power of Buffett's approach. Section 3. From Knowledge to Action, Your First Steps. We've covered a tremendous amount of ground, and it's easy to feel overwhelmed by the wealth of information. However, the journey to becoming a more disciplined Buffett-style investor begins not with a giant leap, but with a series of small, practical, and deliberate actions. The goal now is to translate the knowledge you've gained from this breakdown into a concrete plan. The first and most important step is to commit to doing the work. This means accepting that there are no shortcuts to sustainable success in investing. It requires a commitment to continuous learning and a willingness to put in the time to research and understand what you own. This is the first principle of the owner's mindset. Learn, write your rules, build a watch list, act with discipline. Your second step should be to start building your personal investment constitution. Don't try to make it perfect on day one. Start simply. Open a document and write down your first few foundational rules. What is your circle of competence? What industries do you understand well? What are your non-negotiable criteria for a wonderful business? What is the minimum margin of safety you will require before buying? Just the act of writing these first few rules down will bring immense clarity to your thinking and begin to build the framework that will protect you from emotional mistakes in the future. This is a living document that you can refine and add to over time as you gain more experience. Your third step is to begin building a small, ready-to-buy watch list. Identify 5 to 10 wonderful companies that you would be thrilled to own. These should be businesses that you admire, that you understand, and that you believe have durable competitive advantages. Then do the valuation work, read their annual reports, study their financial history, come up with a conservative estimate of their intrinsic value. From there, calculate your buy price, the price at which you would be getting a significant margin of safety. Now, you are no longer just a passive observer of the market. You are a prepared hunter patiently waiting for Mr. Market to make you an offer you can't refuse. Finally, start small. You don't need to overhaul your entire portfolio overnight. The next time you have new capital to invest, use your new rules and your watch list to make a single disciplined decision. Go through your checklist, confirm the business quality, and verify the margin of safety. When you make that first purchase based on a solid logical process rather than emotion or hype, you will feel a profound sense of control and confidence. This is how the journey begins, not with a perfect system, but with one well-reasoned decision at a time, slowly building a portfolio and a set of habits that will serve you for decades to